In this video, I'm going to break down the ultimate end of tax year financial planning strategy that will help you save money and maximise every possible tax relief opportunity. Hi everyone, I'm Martin Bamford, and in today's society, we're all living paycheck to paycheck. It happens to be one of the most expensive times in our lives because of taxes, bills, and everything else life throws at us. But don't worry, I'm here for you guys and girls with some great tips on how you can control your finances by following my proven strategies before the end of this tax year. These are the most important tax year end planning secrets that you need to know about before the 6th of April. The 2020-21 tax year is coming to an end with the final day of this tax year on the 5th of April 2021. But do keep in mind that the end of this tax year falls on the Easter bank holiday weekend, which makes the effective end of this tax year, this year at least, Thursday the 1st of April 2021. Don't leave things too late. After what has been an unusual 12 months, end of tax year financial planning might not be at the top of your priority list right now. And quite honestly, I always think there's a bit of hysteria about what is, after all, a fairly arbitrary date in the calendar. Yes, there are steps you can take to maximise allowances and take advantage of use it or lose it tax exemptions. But your world is not going to end if you miss one set of tax year end deadlines. That said, smart tax year end planning can provide a welcome boost to your financial planning, which is why in this video I'm going to share 5 key end of tax year planning steps to think about this year, including a little quirk that can boost an ISA allowance by 45%. Without wanting to teach grandma to suck eggs, the tax year runs from the 6th of April through to the 5th of April the following year. Right now we're in the 2020-21 tax year, which means it started in 2020 and ends in 2021. When it comes to tax year end planning, there are broadly 5 things to think about. These come around each and every year. The numbers vary slightly depending on the tax rates and government policy, and the effectiveness or desirability of each of these steps does vary a great deal depending on your personal circumstances, goals, and objectives. As always, what I cover in this video is for information purposes only. This is not advice. Please do seek professional, independent financial advice before making decisions with your money. Make sure the decisions you make are the right ones for you. A whole range of different people watch my videos on YouTube, and therefore I can't possibly know what's right for you, and that's why advice is so important. With that disclaimer said and done, the first end of tax year planning area to think about are your ISA allowances. ISAs, or individual savings accounts, are tax sheltered wrappers in which you can hold cash or investments free from income tax and capital gains tax, also free from tax reporting requirements, which in many cases is the biggest appeal, not having to tell the tax man about any income or gains from the assets within your ISA portfolio. Your annual ISA allowance is £20,000 this tax year, and it's a use it or lose it allowance. In other words, anything you don't contribute towards that £20,000 allowance during this tax year, you're not able to carry over to the following tax year, so use it or lose it. I say £20,000, but that's the ISA allowance for adults over 18s in the UK. To help muddy the waters slightly, there are some other ISA allowances out there, including the junior ISA allowance for under 18s, which I'll cover separately in just a moment, and also the lifetime ISA allowance of £4,000, any of which you use gets knocked off your £20,000 ISA allowance. Let's stick with the lifetime ISA for just a moment in case that one's relevant to you and your financial planning. The lifetime ISA was introduced back in 2017, and it's designed to either help you save for your first home or as an alternative to a pension, saving for retirement. As with an ordinary ISA, with the lifetime ISA you can invest in cash or in investments, what's usually referred to as stocks and shares. There's a £4,000 annual investment limit, but the government adds a 25% bonus to your contributions as an incentive to save more. So if you save £4,000 into a lifetime ISA, a LISA this year, the government will pop another £1,000 into the savings pot, bringing up to £5,000 in total. But these uber generous ISAs are not available to everyone. You can only open a lifetime ISA between the ages of 18 and 39, and then you can only keep it open for new contributions until your 50th birthday. And keep in mind that any money you take out, unless it's for those two specific purposes of buying your first home or once you've reached age 60 for retirement purposes, withdrawals are subjected to a penalty of 20% that effectively takes away the government bonus. But those are lifetime ISAs, and as I mentioned before, anything you put into them is knocked off your ISA allowance of £20,000. So putting the maximum £4,000 into a lifetime ISA means you can only save or invest a further £16,000 into an ISA this tax year. But the 5th of April, or this year effectively the 1st of April because of Easter weekend, it's a hard hard deadline for ISA contributions, so remember, use it or lose it. The second end of tax year financial planning consideration is your pension contributions. The maximum amounts that you can contribute to a pension are made by reference to the tax year, with an annual allowance of £40,000 each tax year in respect of money purchase or defined contribution pensions. Putting money into a pension pot is great for tax planning purposes, especially if you're a higher or additional rate taxpayer. So in other words, if you pay some income tax, either 40% or 45%, that's because pension contributions attract income tax relief. When you put money into a private pension, 20% income tax relief gets added straight into the pension pot. That's your basic rate income tax relief added. And then higher or additional rate taxpayers can claim back the difference between 20% relief and the 40 or 45% tax they pay. So basic rate relief is added to the pension pot, and higher or additional rate relief is claimed back from a taxman, either through your self-assessment return or by asking them to make a one-off payment back to you. This tax relief on pension contributions is attractive, but there's a catch, of course. When you put money into a personal pension, it becomes inaccessible until you reach age 55. And when you do get your hands on that money again, only a quarter of your pension pot is tax-free. The other 3/4 are subject to various rates of income tax. Money invested in a pension grows free of income tax or capital gains tax, a bit like money within an ISA. And it has the added benefit of sitting outside of your taxable estate for inheritance tax purposes. I mentioned there's a £40,000 annual allowance for pension contributions each tax year, but also keep in mind that you're limited to 100% of your taxable income as a lower contribution limit. And some people, those who have taken any taxable, flexible withdrawals from their pension pot already, they have a special, much lower annual allowance of just £4,000. End of tax year financial planning consideration number 3 is giving away your money. One of our favourite things to advise clients to do as financial planners is to spend or give away their money. After all, what's the point of working so hard to earn money, to build wealth, if you're not able to enjoy it a little bit or see those you love enjoying that money? A big end of tax year planning step is to make gifts to help reduce the eventual inheritance tax bill faced by your children, grandchildren or other beneficiaries of your wealth when you die. As things stand, there is a nil rate band on inheritance tax of £325,000 and then an extra main residence nil rate band of £175,000. That applies when you leave the value of your home to a direct descendant. But the value of your estate, in other words, the stuff you own, which is more than those nil rate bands, does get whacked for inheritance tax at 40%. However, you can give money away during your lifetime to help reduce the size of that taxable estate, so your beneficiaries ultimately pay less in the way of inheritance tax. Each tax year, you can give away up to £3,000 tax-free as your annual gifting exemption. Unlike that ISA allowance, which I referred to earlier as being a use it or lose it allowance, any unused gift exemption can be carried forward until the following tax year, but only once. There are some other gifts that are exempt from inheritance tax, including gifts worth up to £250, which you can give to as many different recipients as you want, but not anyone who's received part of your £3,000 annual gift exemption. You can also give money away as wedding gifts, up to £5,000 to a child, up to £2,500 to a grandchild or great-grandchild, and up to £1,000 to another relative or a friend who's getting married. There's yet another inheritance tax gift exemption, and that's gifts made from your surplus income. These gifts must be regular, and making those gifts cannot reduce your standard of living. An example of these is when grandparents make gifts to help fund private education. That's one we see fairly often. With any of these gifts, please do keep a good record. At some point, once you've died, somebody's going to need to be able to prove to the taxman that these gifts were made. So record keeping is so important. There's another type of giving money away, I guess. This one's step 3A, and that's charitable donations. You get tax relief in the form of gift aid when you make a donation to a registered charity or a community amateur sports club. These charities can claim an extra 25 pence for each £1 that you donate. And much like with the tax relief on your pension contributions, you can claim back the difference between basic and higher rate tax relief on your gift aid donations. You need to pay enough tax to qualify for gift aid, and the limit here is making sure your donations are not worth more than 4 times what you've paid in tax in that tax year. The tax that you've paid could be income tax and or capital gains tax, but that's essentially the only limit on this form of tax relief. Once again, make sure you keep good records. What I tend to do is print off a record of my donations via Just Giving and give that page to my accountant each year so he can calculate how much tax relief I'm able to reclaim. The fourth end of tax year financial planning step to consider is all about capital gains. It's been a good year for investment markets and for property prices. The value of most things has gone up, and that means you're likely to be sitting on some capital gains should you sell those assets. You pay capital gains tax when you sell investments or property at a profit, and while your main residence is exempt, and so is money held within an ISA or a pension pot, anything else you own is pretty much fair game. Capital gains tax is charged on profits at 10% for basic rate taxpayers, 20% for higher rate taxpayers, or at 18 and 28% respectively if you're profiting from the sale of a property that's not your main residence, that's not your home. However, each tax year you receive an annual exemption. That's an amount of capital gains that you can realise without having to pay capital gains tax on those profits. For this tax year, 2020-21, that annual exemption is £12,300, and it's another use it or lose it one, so you can't carry it forward if you don't use it up within a particular tax year. Capital gains tax planning can get pretty complicated, so it's worth seeking advice from either a financial planner or your accountant if you're making gains, or losses actually, as those can be carried forwards in some circumstances to reduce the amount of gains subject to tax. But one fairly handy capital gains tax planning strategy is to transfer the ownership of investment or property to a spouse or civil partner. That's because capital gains don't occur when you give an asset to a spouse or civil partner, and then they can make use of their annual exemption. They might also pay capital gains tax at a lower rate than you, so 10% or 18% rather than 20% or 28%. This transferring of assets before selling them can save you a lot of money in the right circumstances. My fifth and final one in terms of end of tax year planning is in respect of children. So this one's for the parents out there. We've talked about ISAs, and I mentioned junior ISAs for the under 18s. The junior ISA is basically an ISA for kids. It's allowing them to save or invest in a tax-free environment. There's a lower annual allowance, but it's still pretty generous. It's £9,000 this tax year. It's another use it or lose it allowance, so not carrying any of it into the next tax year, but it's a separate allowance to your £20,000 ISA allowance. So you can invest both £20,000 into an ISA for each adult and up to £9,000 into an ISA for each child. That £9,000 allowance can be split between cash or investments. Much like the adult ISA, you can have up to one of each type in each tax year. Money put into a junior ISA has to stay there until the child celebrates their 18th birthday, at which point they own it entirely, so they can blow it on a motorbike or a car, or they can use it to fund higher education, set up a business, or put it towards a deposit on their first home. But it is down to them how that money is used. There's a quirk that you should know about the junior ISA, but it only applies to 16 and 17-year-olds. At those ages, children get two ISA allowances: their junior ISA allowance of £9,000 and their adult ISA allowance of £20,000. So in each tax year, they get those two allowances when they're 16 or 17 years old. So 5 key areas to think about as the end of the tax year approaches. Of course, most of the steps I've explained in this video rely on you having some spare cash to invest. If you're in that position, it's essential to first have a financial plan in place before you decide how to allocate your spare cash to best achieve your goals in life. End of tax year financial planning should not be driven by the availability of allowances, reliefs, or exemptions. We have a saying within our profession, which is never allow the tax tail to wag the investment dog. And the same can be said of tax tails and financial planning dogs. Start with the financial plan and then see which allowances, reliefs, and exemptions you can use to support your progress with that plan. All too often, I see the looming end of tax year used as an opportunity to flog investment products. We hear this horrible term, ISA season, which is where you see direct-to-consumer investment platforms promoting specific investment funds and encouraging you to put money into them within your ISA or even your pension. Don't feel pressured into making investment decisions simply because there's a date in the calendar approaching. It's far more important to get your plan right first and to make sure you've covered the fundamentals of financial planning. Do that before you get lured into ISA promotions and investment funds which might or might not be right for you. At a pinch, if you're concerned about missing the end of tax year deadline, you can pop money into an ISA or a pension and then leave it in cash until you've got time to make a considered investment decision. If you do this, make sure of a couple of things first. Make sure it's actually cash and not a money market instrument which can lose you money. And make sure you pick an ISA or a pension product which does not have any exit penalties, so that if you need to, you can easily move money to a more suitable platform or product in the future once you've had time to get advice. I hope the steps I've outlined in this video were helpful, and I hope you have a peaceful end of tax year, taking advantage of any tax allowances where possible and advantageous for you, your circumstances and your goals. I'm very happy to answer any questions you have. Just leave them in the comments down below and I'll do the best to answer them quickly or point you in the right direction for further information or resources. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.